Good morning and welcome back to Almus Market Mornings. The ripple effects of Trump's Liberation Day are still playing out across the global markets. While traders were focused on tariffs, OPEC Plus quietly delivered a surprise, bringing forward multiple months' worth of supply of oil production into May. The move sent oil prices lower and added another layer of complexity to an already tense market landscape. At the same time, the dollar weakened noticeably, the euro rallied sharply, the rupee gained ground, and bond markets caught a strong bid with US yields slipping. Traders are now leaning into the idea of rate cuts and safe haven demand remains firm. JK, with this oil prices rising, central banks turning cautious, and tariffs still front and center, are we on the cusp of a new trend for the dollar?
Good morning, Swaraj. Yes, I mean, if you are talking about a new trend change for the dollar, I think we are not far away from it. Although yesterday's moves still kept the dollar within the broad range of the last 1 year. However, the move in yesterday's trading of 2.5% fall in the dollar index was a very rare move, and it was probably something that the market was not prepared for. So why I say a new trend for the dollar can emerge on the downside is one is you look at the markets, uh, deep risk off and the dollar falls, and that is against the historical behavior of the market. Secondly, US is slowly detaching itself from various global institutions, and now it's not being seen as the global leader for the markets or for the global issues as a whole. And finally, there is a certain loss of confidence, I would say, of reserve managers and the big investors on the US policies, because the kind of shifts that they're making. Uh, just give you an instance. 2 years back, US was supporting the war in Ukraine and funding them massively. And 2 months back, they have started to negotiate not only not funding the Ukraine war, but also demanding Ukraine to compensate the US immediately by way of allowing access to their natural resources. So these are the kind of things that removes the confidence on the global leader and the currency, and that is definitely going to reflect. We don't have an alternate immediate big leader, but I think it can be a multipolar world. Probably Euro is currently taking that first lead. So that is where we are seeing a lot of money flowing into Europe. Apart from the fact that Europe is already doing a lot to, liberalize the spending on infra and defense to, get themselves into self-secured position. So that's what it is. I think, to answer your question more clearly, I think dollar is probably entering into a long uh, decline, um, declining trend. It can extend to even years. So that would be my answer. Yes, coming back to what happened yesterday, the tariff terror actually turned into a nightmare for the markets, and we had the US stock markets falling between 4 to 6% in a single session, and stocks actually pricing in the recession. 10-year dropped by 17 basis points and 2 year by 20 basis points. 2 year is actually now quoting at 3.66%, which is like it was at 4.38% just 2 months back. And if you look at the market discounting of rate cuts by the Fed, CME Fed Watch tool shows more than 60% probability of 4 rate cuts and more than 90% probability of 3 rate cuts. So that's how the market have shifted. While the tariffs themselves are quite negative for the US economy, it's a self-inflicted, uh, difficulty for them, for the economy. The economy is also seen already struggling with consumption and slowdown. And data yesterday published were quite evident. US employers announced job cuts of as much as 275,000, and this is the highest since May 2020. The services activity level fell from 53.5 in February to 50.8. We had the fall in employment. We had the new orders falling, and the overall services business activity was lower. And of course, prices rose less than last month, but it's still at a very elevated level of 60.9. And as for the weekly jobless claims, while the weekly number was lower by 5,000, 6,000, the uh, cumulative claims have actually increased by 56,000, actually indication that unemployed individuals are finding it increasingly difficult to re-enter the workforce. So these are the catalysts that the market needed for further fall in the stocks, yields, and the dollar. And no notable recovery has been seen in the Asian markets today, as, as investors continue to reel under the bearish atmosphere. What is also, of course, notable is that the dollar has fallen amid a huge risk of, and even the risk of, and the losses in the stock market were so deep that even some investors tended to take profit on the gold, which is supposed to be a safe haven in such times. And even gold saw some 2 to 3% fall, although it has since recovered also. Now, as far as the dollar is concerned, it wiped out all the gains that were made since Trump was sworn in as a president. It hit a low of 1.267, just one big figure away from the low that was seen a year back. And so that is at 100.16, and market is looking closely at that level. Now, from here, where see, we are now looking to Friday's non-farm payroll report for further signals about how the economy is doing, particularly on the employment. Although the forecasts are not so bad, unemployment rate remains at 4.1%, and the wage increases are also not under control. I think market will be prepared for some surprises. We also have Jerome Powell speaking on economic outlook in one of the private events, and that we in this crucial hour, possibly listening to his statements would be very important. And so, amid all this, one person who will be loving it all, who is the Treasury Secretary, because what he is getting is higher tariff means slower growth, and slower growth means lower interest rates, and that is exactly what the US government wants. As they look to roll over as much as 7 trillion of borrowing this year, and even a fall of 0.5% in the rates would be a great boon for their balance sheet. So that is where it is. I think we look forward to more data, and we can see some recovery. Because there are repeated statements from Trump as well as administration that they're open to negotiations, and what is announced is the worst case scenario. So I think market will also look at how the other countries respond and how much they yield to US demands on non-tariff barriers. Now, as for the rupee is concerned, it has strengthened more than 3% from its recent peak. Even it's also surprising, kind of, because we had 27% tariff on our exports, and we have as much as 78 billion of gross exports to the US. And although a few products are exempted, like pharma and the billion, its impact cannot be neglected. But it appears that the market was kind of prepared for the tariff that was imposed, and stock markets really stood out. While almost all the markets lost between 1 to 4%, Indian markets saw a very, very marginal loss. And the rupee, of course, was looking more at the dollar index and gaining. The gain was not too much, because we had already seen 40 on last day of March, and the low that we saw yesterday was about 85.43 in the local trades, and in offshore it traded a low of 85.20 as well. But directionally it is still on the downside, as long as the dollar index is also falling. But what holds from here is important, because while the tariffs are going to impact our trade balance, some estimates are that we may lose, or rather we may see deficit increasing by about 18 billion per annum. At the same time, it's not a situation where you would like your currency to strengthen by as much as 3 to 4%. So having already moved so much, I think the central bank could be well aware of how to arrest further they need to arrest further declining the dollar, and we might as well see them levels of 85.30 itself, or maybe at slightly lower level. I'm not sure how many are looking to go fresh short in the USD INR at these levels, which was seen about a year back. Although one would also wait to see whether the really uptrend goes beyond 86 or not, because the people have been left out in this sharp fall to sell. So there will be sellers all along the way, but some marginal recovery is definitely overdue as far as the dollar rupee is concerned. We just look forward to the central bank as well as the government states on how they are going to tackle the tariff issue with the US government. Thank you.
Thank you, JK. And I would say a very, very tricky situation when it comes to market moves because one hand dollar has been weakening quite significantly, wiping out all the gains since it made when since Donald Trump was elected as president. So all the gains have been wiped out. US data at the same time continues to come in weaker. The recent services sector activity has continued to struggle. Even the contingent claims has been rising. So there is a picture of a weakening US economy, and that has resulted in markets pricing more rate cuts. So the Fed Watch tool by CME now showing probabilities of 4 rate cuts this year and over 90% probability of 3 rate cuts this year, which is very significant, and that's what the markets are pricing. And as JK mentioned, more importantly, the Treasury Secretary, Mr. Besant, must be loving this because there are $7 trillion worth of debt which is due for refinancing, and they want lower yields, and sort of they are getting what they want. Rupee, on the other hand, domestically has strengthened significantly. And in fact, even Indian equities saw only a marginal loss despite the big losses elsewhere around the world. And for Rupee, we made a low on the onshore market at 85.43, but even 85.20 was seen in the offshore markets. But as JK mentioned, at these levels, maybe fresh shorts for USD INR seems unlikely, and some marginal recovery is possible. That's it from us today. Thanks for listening. Have a very good weekend, and we'll catch up on Monday with a fresh round of updates. Thanks for listening.